Hello and welcome, everyone. Excited to have you with us today for this webinar. I'm Brett Theodos. I am a senior fellow at the Urban Institute. Just a couple of housekeeping things as we get started, and then we'll get to the main event. First is that our event is being recorded, and we'll post online that recording for friends and colleagues who weren't able to join, or if you want to go back and re-listen. All of the participants are going to be muted, but you can send in questions or comments in the Q&A box at any time. And we are tweeting using the hashtag #LiveAtUrban. So would welcome you to join us on social media as well. So I'm going to briefly frame our context, and then we will bring in the panel to the discussion. So first, why this matters. I think it probably doesn't need to be said, but we know that in this COVID pandemic moment, that things are very challenged, in some ways looking worse at the moment, not better, though we have hopes for long-term recovery. We are also facing, about to have a transition in government, a new administration, likely a divided government. Stimulus is struggling to emerge, even in a lame duck session, and if not, the hope is in a new Congress. There's certainly a big push to do something, but a clear divide as to what to do, how to do, and how much to invest while doing it. In some ways, small businesses are faring better than we would have expected, perhaps, as of the spring. They got a big boost from the Paycheck Protection Program, PPP, and through disaster loans and through other efforts, CARES, through community development block grants, some of that found its way to small businesses. So indeed, there were a number of sources of support, of which PPP was the largest for businesses. And in a way, also a source of support for lenders. But clearly, many small businesses have been very severely affected. Some have been lost, and others are questioning how long they can hold on. So today's discussion is about what's next. What are the needs for businesses in accessing capital? What are trends for lenders? What are policy issues at play? This is a panel of lenders. We're going to hear the lender perspective on the provision of capital. The business owner's perspective is very important as well. It's not what we're going to be lifting up in this session, but of course that is an important element. So with that context, and to understand what lenders are doing in this moment and how policy can best support the provision of capital, we're going to turn to three folks who can build out the discussion for us. So first is Janie Barrera, who is founding president and chief executive officer of Liftfund. And joining her is Christopher Hollins, who's managing director, GM of cash management at Chase Business Banking, JPMorgan. And finally, I will be joined by Jason Tepperman, who's the managing director at Promontory Local Credit. And so welcome. Thanks all of you for joining us.
Thank you.
Thank you.
Great. So we're going to start off with a lightning round of tell us who you are, what kind of small business loans you make, anything about your volume, just help build out the picture of your financial institution. So Janie, let's start with you, and then Jason, and then we'll go to Christopher.
Thank you, Brett. Liftfund is a 26-year-old CDFI, a community development financial institution, obviously a not-for-profit CDFI. And we are based, our headquarters are in San Antonio, Texas. That's where we opened up our first shop. Now we serve 13 states across the southeast part of our country, from New Mexico to Florida, up along the Mississippi River, and then Georgia. And our product is getting people to build assets. And that's the way we do it is by lending money to small businesses that cannot get the loans from the traditional financial institutions. Our business model is that we want to lose our best customers. We report back to the credit bureaus their payment history with us so that they can increase their FICO scores and go into to the traditional financial institutions. So we are funded a lot by either national banks or community banks, foundations, individual gifts. either through investments or direct donations for us to be able to make these loans. Our loans are micro loans. They can start as little as $1,000. And we go up to the highest loan, or the largest loan that we make, is $500,000. We also participate in most of the SBA programs that CDFIs can participate in. So we are a SBA micro lender. We are a 7A Community Advantage lender and SBA 504 lender. And in 2 cities in Texas, we operate women's business centers, also partnering with the SBA. So not only do we provide access to capital, but we are a strong believer in the technical assistance piece to be able to sustain these small businesses and help them grow. So thanks for having Liftfund here, Brad, as part of the panel.
Thanks, Janie. My name is Jason Tepperman. I lead Promontory Local Credit. We are a small business lender as well. We focus probably just from the top end of where Janie's firm leaves off, and then up to maybe the small end of the lower middle market. So typically the businesses we lend to are 5 to 50 million in revenue. And what we specialize in are situations where business is obtaining some amount of capital from its bank, but not quite as much as it was looking for. And in those cases, we'll provide some additional capital beyond what the bank is lending to help fill the remaining gap that the business has. Most often, these are businesses that are good businesses, but have a significant opportunity in front of them. So there's perhaps a company is looking to acquire a competitor down the street. One partner in a business is looking to acquire another, looking to buy out another partner. The business owner wants to sell his or her business to their management team and affect a transition. Someone's staffing up for a new contract, opening a new facility, that type of thing. We're affiliated with a firm called Promontory, which is a large service provider to a few thousand banks around the country. And so we tend to work very closely with banks in putting this solution together.
Then finally, Brett, JPMorgan Chase, many people know that name. We're a national bank. We are a full service bank. We go from probably 25,000 to a lot more than that. And from a small business perspective, I love Janie's comments that she wants to graduate her best clients to the banks, and I want to be one of the recipients of some of those clients. And at the same time, if we've got clients who are on their journey but not yet in a place where we can responsibly provide access to capital, we want to be able to refer our clients to people and to CDFIs like Janie's to make certain that they are going along their journey as they are better understanding how to manage their business, manage that liquidity, which then starts to get you the reporting that allows for credit scores to improve, and then hopefully in a situation where you can optimize your access to capital based on hopefully having some optionality. We, much like Janie's group, as well as part of what Jason's does, we are 7A Community Advantage lender. We do 504. We are also spending a lot of time, especially as a part of our $30 billion commitment to being more intentional around our social activities for underserved entrepreneurs. Minority entrepreneurs is what we're focused on. That is a build out in technical assistance, making sure that we're working with more partners who can expand our ability to provide access to capital, with the overall goal of making certain that anyone that comes to us, even if we can't help them directly, we figure out a way to help them move along their journey successfully.
Awesome. Thank you all. We've got a good picture of where you sit and the work that you do. And I think this is a great representation of some of the spectrum that's out there in the lending community. So thank you to JK for putting our first question in the Q&A chat. Just encouragement as we go along to others of you to pop in, and I am gonna promise to hold time after we get through some of the planned questions to work in questions that you all put in as well. I will lift them up to the panel, so please go ahead and put those in as we go. So the thing that I wanted to turn to first, now that we understand who you are and where you sit and what you do institutionally, is what you can tell us about the current state of your small business borrowers, loan performance, how it compares, losses, forbearance, how concentrated that is in certain sectors. What can you tell us about how your borrowers are faring?
I'll give it a start. So I know for the business bank, the line of business that I report into, so far we have seen limited deterioration in terms of overall quality of borrower, meaning that we're not seeing the delinquencies and basically the loan closeouts that we would have expected at this time. We think that that is in part because PPP, when people got those funds, they were very stingy with them, appropriately so, figuring out how, if I, happen to get $100,000 from this particular program, how did I make that look like $200,000 from a cash flow perspective, making certain that I'm still, relatively cash rich. I think many banks are seeing that just in the form of their deposit growth because of the stimulus. The biggest concern, Brett, and as I know that my colleagues here also feel this, is that as you move into 21, without continued stimulus and the COVID outbreak not looking like it's ready to subside anytime soon, that we may see some deterioration in 21 that is greater than we would have planned for, given that we planned for most of that to have occurred already.
Yeah, I echo that, and that the fact that the stimulus funds that came in were very beneficial to our small businesses. I lament the fact, though, that CDFIs were not allowed to participate in the program until the second round, which set our customers then back some, and the fact that the average school or PPP loan, for example, that Liftfund did was $20,000. So, and we did 25 million of those. So there was a need. It's too bad that there was a deadline as well, because more folks could have taken advantage of that, especially sole proprietors who initially did not realize that they were eligible because through their Schedule C and so on, to be able to apply for the PPP loans. So that being said, our portfolio right now, we usually have about a 5% delinquency, and we're about 10. We have the same thing as Christopher is saying. We believe 21 is, we don't know what's going to happen, but we're positioning ourselves for a higher delinquency at that point. What has helped this year is the strong programs that came through the SBA for payment plans. I mean, SBA in their 7A and 504 actually paid 6 months worth of payments for customers, which helped tremendously this year. But if we don't get another stimulus next year, what's going to happen? So that's very important in terms of policy, that we look at, see what programs did work this year. What programs did CDFIs across our country use to be able to reach that community that needs to be reached? 85–90% of our portfolio are service industries. A lot of service industries were non-essential. You had to shut down. And then right now with the rise in COVID and across our country, program or businesses are being shut down again. So we've got to look and see where else can we help with stimulate these small businesses. And basically, we here at Liftfund are looking at a triage approach, not only with the help that we can provide, but also the community. I've had bankers come to me and say, hey, is there some mentoring that our bankers could do with your customers so that we can help them? And then we promote our customers also in our communities. For example, the Saturday after Small Business Saturday after Thanksgiving, We're encouraging people to come to our businesses, either online or takeout or whatever, to serve our businesses. And we're putting that word out in our communities. Let's support our own people in our own community.
Yeah, Brett, I'd echo both those. In our business, we tend to focus on a slice of fairly high caliber credits, and historically we haven't lent into the sectors that were hardest hit by COVID. That said, we've not actually had any defaults or payment deferrals in this period. To be sure, a number of our borrowers have seen declines in their financial performance. For the most part, these have been manageable declines, 10, 20, 30%, comparable to what one would find in a more typical recession. We've also seen borrowers have to, while their financial performance has remained strong, they've had to work very hard operationally to reorient their business. So as an example, we have a business that we lend to that provides janitorial services. And one of their large segments that they serve is universities. Another large segment they serve is healthcare. Their university business is doing very poorly right now. Their healthcare business, for better or worse, has seen a large spike in demand. And moving people and moving equipment and obtaining PPE to be able to make that transition between its customers has been, operationally an enormous managerial challenge, even though the financials have held steady. Now I realize that sounds, on the whole, that probably sounds positive. I think the data suggests that there is a fairly large crowd of businesses in this place. The Census Bureau has been leading a really insightful panel survey about the effect of COVID on businesses. And in the most recent reading, as of, I think, October, about a quarter of the businesses reported that they've seen no effect or a positive effect from COVID. And about 45% report a moderate negative effect. In the survey, less than a third of all the businesses reported a large negative effect. And that pretty much mirrors what we see in the market, that there's a third of businesses that are pretty hard hit, and the remainder that are either dealing with some challenges they can address internally or are relatively stable. The other thing the survey said was that 95% of businesses report they have not yet missed a loan payment, in part because of their performance and in part because of the stimulus. And that mirrors what we see as well.
Great.
I think, Jason, to the point you're making, if you then make that slice by women-owned businesses and people of color, you may get a slightly different percentage. We're seeing percentages significantly higher than a third for those segments of business owners who have seen a dramatic negative impact. My hypothesis would be that if it's in a hospitality service related industry, or in some cases, especially if they were in one of the harder hit urban areas, walk-in retail, that those have been suffering in a much greater clip. But I do agree with your point that the ability for a business to transition itself, to find other alleyways for it to survive during this changeover, has been absolutely critical and something that we've been guiding a lot of businesses to help them do, because without that central business, operating in a way they expect it, they need other ways to make certain that they're still being able to produce positive cash flow.
Yeah, Chris, I think you're absolutely right. If you split the numbers by minority-owned businesses, women-owned businesses in urban areas, the story there is markedly different, and as well by business size. And I think what that really signifies is the need for some really targeted policy responses that can help these communities and help businesses there, because the impact has been enormously disproportionate and unfairly so.
Yeah, and I could add there as well, in the municipalities in which we work that received CARES money, Liftfund was a pass-through grant pass-through grant program. And so the municipalities actually put the requirements together, not Liftfund. It wasn't true. It wasn't underwriting. It was based on criteria from the cities and the counties. And so it was criteria such as, $1 million in revenue or less, 10 employees or less, affected by COVID and so on. So that the purpose was to reach the minority women-owned businesses that either did not qualify for PPP or just didn't know how to get PPP.
So let's lean into that. And this is terrific dialogue. Thank you all. This is exactly what I think our audience wants to dig into. So we heard that emerging findings that the effects of COVID on businesses have been disparate across the dimensions of race, ethnicity, and size, and gender, and sector. And yet our biggest effort to support small businesses, PPP, was not a well-targeted intervention. It was very general or universal in nature. Obviously, there were some qualification criteria, but few relative to what there could be. So I'd love to talk about PPP, since it is not just rehashing history, it's also up for debate as we think about new stimulus. What difference did PPP make in the firms who were able to access it? What did they do with the funds? To what extent did it help some firms survive versus give firms a boost that would have been fine without it? And what kind of firms were not able to access PPP? So any one of you can start.
Well, I think that the ones that were unable to access, we've been pretty clear about, as Janie has already stated, a lot of sole proprietors, a lot of clients of smaller banks, of CDFIs, also had a lot of trouble being able to get in on the first, or even what I'll call round 1A, because I don't know if there was ever really a second round. And that is a large proportion of business. So I'll give you one factoid, at least among African-American owned businesses, 94% of those are sole proprietorships. So you put that statistic against the way that PPP was initially implemented, significant portions of Black business owners were not able to access PPP. That also, I think the other piece of this is that it was intended for large small businesses that had lots of employees, because it was thought that you get one business, you positively impact 50 to 100 employees, and then you get a downstream impact of those families not suffering and the like. I think that the marketplace for small business is much more a tapestry, a complex tapestry, than was originally thought through the PPP initial implementation. And so that left out a significant portion of the population that doesn't fit neatly into that narrow lane.
Yeah.
Yep.
80. Oh, I'm sorry, Jason.
No, please go ahead.
85% of our PPP loans were not part of Liftfund's portfolio or radar screen. These are people that never had even heard of Liftfund before, and were told by their bank that we can't help you, go to Liftfund, or by others go to Liftfund. So I think that piece of information is important, because again, I'm putting a plug in here for CDFIs across the country. That has been their experience across the board. And interestingly enough, we were still able to do it even though we had that requirement of know your customer. Banks know your customer because they have our money. 85% of the people that we served with the PPP, we didn't know anything about them. So we had to go through that due diligence with each of our customers and being able to provide that loan. And then what also happened in the service industry for the PPP restaurants and bars and so on, their minimum wage or less people were able to get unemployment for staying at home. And it was harder for them to get the workers to come back. And so, so that happened in some situations. In other situations, I know a restaurant that had their own family as employees, and plus others that were part-timers or whatever. With the 3 or 4 family members, they just kept it afloat by providing takeout, right? So the people were calling in, and the family worked 24/7 because they had half the crew, but that's how they're keeping alive, and that's what they wanted to do. So I think there's a lot of resiliency in these small businesses. They're going to figure out a way to do it. And if we go through another PPP program, the policymakers need to look at these issues that happened and learn from it and tweak it. Oh, and then the other last part before I pass it on to Jason is that, remember, most CDFIs are not banks, and so we have to rely on investors. And because it was guaranteed by the SBA, Goldman Sachs called us up and said, "Hey, would you like 25 million to be able to use?" And other banks as well, right? So a program, that part of the program did work, right? Because it was the incentive of the guarantee portion that the CDFIs then could work with.
Yeah, I think one of the core challenges with PPP is that it was probably too generous to the companies that didn't need it, and not nearly generous enough to the companies that truly did. It's an incredibly popular program among business owners and politicians. There are some terrific anecdotal stories around it. I think the academic research to date suggests that as a policy, it was largely ineffective at reducing unemployment. I would speculate in part it's because a large portion of the PPP funding went to businesses that by most conventional measures are not truly small businesses that employ over 100 employees or more. Raj Chetty and his team at Harvard have done some detailed work around this, and they estimated that the program provided less than a 2% employment boost at a cost of $377,000 per job saved for 5 months. And $377,000 is an interesting number because the average annual income for these workers is only $45,000. So I think that invites some difficult questions about where $500 billion went. And I think when the numbers, when folks have some more refinement and there's not this level of granularity yet, it'll suggest that there's a number of businesses that use the money to pay workers that wouldn't otherwise have had other resources with which to do that. A number of them probably still found that 2 months of payroll was inadequate to make it through what looks to be a year plus cycle of COVID. There was an article in the Wall Street Journal about on exactly this point today. But I think for the businesses that weren't in that situation, the roughly 2/3 of businesses that haven't seen a severe impact from COVID, this was capital that it may not have actually been needed to support their operation.
Great. And then the question emerges of whether those businesses have even really spent the resources and boosted the economy in a secondary way, or it's just sitting in balances at, depository institutions. I have, been observing examples from Europe and Canada where there was basic income targeting on the basis of reductions in earned income as an eligibility criteria, which they were able to include in their first round of stimulus. Not that complicated of a process, but something obviously we can consider the next go round. So I want to take
Brett, to your point, if you're truly interested in stimulating the economy, it's small business owners, meaning under 50 employees, and it's consumers, basically the employees of those small business owners, who actually drive the consumer aspect of the U.S. economy. So the money in their hands will get recycled faster and will keep the economy going more so than providing it to larger businesses who have many different ways to allocate money provided to them that are in some ways more financially beneficial than pushing it all the way through the process.
So this was a really helpful discussion to understand history. Now I want to bring us up to the current moment and your institutions, not yet getting to policy, but just help us understand the current moment because we're still living in this space before we get a vaccine. What do loan applications look like? Credit quality, volume, whatever you can tell us about how demand for credit and supply of credit is now. Now that we're after PPP and we don't have that boost, how does it look right now?
I'd say the demand is picking up over the last 3 or 4 months. That seems natural. I think the supply is what's going to be at issue. Primarily, Brett, is if you think about it, for 6+ months, small businesses don't really have financials, or their financials are in a much different business case than was originally the documentation for access to capital. If you don't have real clarity as to what the foregoing revenues are of a business, it makes it very difficult to underwrite it in such a way that it would be affordable capital to that business owner. And I think that our institution, like many others, are struggling with figuring out appropriate algorithms so that as you go into 21 and having business owners, even ones that you've got as clients who may have had inconsistent revenues for the last year, how do you responsibly lend to them if they've got that request for capital? So those are some of the challenges that we're attempting to work through.
Our demand is up, and what we're doing in terms of underwriting is looking to your point, Christopher, that we got to, what did they do in 2019, right? It's not what happened in this last 9 months or 10 months. So that's one of the things that it's changing. We're not looking at now, we're looking then, and then the potential for the future. And also because we are looking at both, funding from banks and, like I said before, and the federal government, but also philanthropy. And so the dollars that we are receiving now is to buy the interest rate down so that we can offer loans even at interest rates even below. I never thought I'd say that we were in competition with the banks, but we may be in terms of offering a better rate because we've gotten some injection of grant money, and in addition to some federal money that we're able to use, like from Department of Commerce EDA program. So that's a grant that we'll be able to use for lending, coupled with interest buy down programs. And then bigger thing for us internally will be the loan loss reserve. And how do we build that so that we can continue to do our work?
Yeah, I would just add on to that. I think loan demand really follows the shape of the recovery, and there's a lot of talk about, is it a V or a K or a swoosh or choose your shape. For us, new loan applications are probably best pictured as what we call lowercase k. We see a lot of the distress situations in the industries you'd expect. Restaurants, tourism, travel, the sort of the accommodations, in the NAICS code, the category 72, that's the downstroke of the K. But then there's a lot less activity among healthier businesses. Healthy companies tend to typically only borrow when they're looking to accomplish something that's significant. And they're taking a big swing at an opportunity that they see. And there are just many fewer businesses in that mode at the moment. Though that's something that we do expect will change in the next quarter or two. There's a lot of I think there's a lot of pent up demand to take, to move in toward a growth mode. But, I think folks are also naturally reticent.
And there's a lot of pent up inventory as well. Most small businesses who are retail, for example, were thinking ahead in December and January of this, January of this year for the summer months and so on, and buying the inventory that they needed. And now it's in a warehouse somewhere and it's still there. It's good inventory, but we've got to keep them alive to be able to sell it next summer. And so those are the things that we're looking at, the potential of the future.
So I would envision that going, we're going into the beginning of 21, there's going to be a significant increase in demand. It's normally a high demand season anyway, as you move into seasonal businesses in the spring and summer. That's kind of the natural life cycle. In addition to all of what is occurring, I would imagine we'll put more pressure on that first 3 to 4 months in terms of where businesses need capital, basically cash flow to get themselves through the inventory period so that hopefully they can sell in the spring and into the summer.
And so let's do that. We're moving that direction. Let's start to look ahead on where we go from here. And I'll leave it up to you and where you want to speak to, but I think the audience would be interested both in where you think we will go, as well as where you think we should go. And I ask that in terms of what federal policy is needed to help small businesses survive, even in a life support scenario through the COVID winter, metaphorical and literal. And so what federal policies, stimulus, exceptions, bonuses, benefits are needed, whether that's through SBA or otherwise. Or if you want to speak to it, what can and should lenders do, philanthropy, local government, small business serving organizations, technical assistance providers, and so forth. Where do we go from here? We've got our near term, getting through this COVID before our economy is back on its feet, and then even longer term as we again return even to a baseline that in many ways was not very good when we look at disparities in business ownership and scale and access to credit. And so would love your reflections on where we are going and where we should go to even arrive at a better place.
Well, what I would love to, no, go ahead, Jason.
No, go ahead, please.
A couple of things. I think moving into next year, certainly have to be very focused on helping as many small businesses have their cash flow and their cash situation in order as possible, so that they can do kind of a true look in the mirror as to where their business is today and what needs they may have going into 21. We're spending a lot of time working with CDFIs. So Janie, I am a proponent of CDFIs. We're working with CDFIs as well as within our own bank to make sure that we are at the grassroots, addressing challenges that small business owners may have coming out of this particular year, but more importantly, helping those businesses get the technical assistance that they need, such that if there is a request for capital, they're in the best position to receive it. That's one thing. From an SBA perspective, and I don't think this is anything that my colleagues would disagree with, digitization of their loan application in a true digital way would be significantly helpful to many small businesses. That's a primary place where people go when they're even searching on a search engine for small business lending. And those things don't kind of line up. I think especially as you're looking at whether it's another PPP or some form of stimulus that goes to small businesses where financial institutions and the SBA are involved, being able to make it easier to actually apply, get approval, and to get the money to the particular businesses would be of tremendous help coming out of COVID.
Yeah, I would add that there is discussion and it seems likely stimulus, the third round of PPP, part of it. But I think there's a broader issue as well, which Yelp came out with a statistic a little while ago that 60% of the businesses that they had shown were closed due to COVID are now shown as permanently closed. That was as of September, and with the delay in the stimulus and the coming winter months, I think the unfortunate reality is that there are more that will close. that there's going to be some significant economic wreckage that comes out of this. But it also seems to me that that need not be a permanent state of affairs. A restaurant that worked well, just as an example, on a street corner in 2019 is likely to work well again in 2021 or 2022 as our society recovers. And I think beyond PPP, there's an enormous opportunity to develop policies that not only sustain businesses through this period, but for those that simply are unable to make it through this period, will help businesses and their owners restart their operations and rebuild main streets. And Chris, to your point, I think the impact the impact to women-owned businesses, to minority-owned businesses, has been particularly severe and disproportionate. And it would be worth targeting policies to help address that disparity. Some of that can be loans, but there's likely to be a need for equity capital contributions as well.
And along those lines, one example of how CARES money was used was to forgive debt. So they provided grant, and to, again, 100% of the portfolio that we serve are underserved and underserved and can't go to the banks, right? So by taking that debt away during this time was crucial in helping them survive these days. So more CARES money going out to municipalities, and municipalities using them would be a way to continue. We administered about almost 50 million of grants, pass-through grants to the small businesses. But the requests were, more of around 500 million, right? So there's still people out there that are in need and want, but just, there wasn't enough money. So in other terms, in policy would be the Cdfi Treasury, the Cdfi fund, making sure that that fund continues to grow and not shrink. Because if you look at the history of CDFIs, and I'm sorry if I sound like a broken record here, but it's true that if you look at the history of CDFIs and the way they use their money that we receive from government or other places, our default rates are so much lower than other institutions, for-profit institutions that work with these high-risk individuals. In our normal time, the FICO score, one of our customers, is 580, right? The cutoff at a bank is 680. So, and we had, before 95 to 96 repayment rate. So TDFIs learn how to do this work because of our technical assistance and so on. So dollars that have been in place need to stay in place at a minimum and grow by 50% more if possible. From the CDFI funds, from the SBA funds, and then to continue with the CARES money that was made available to cities across our country. And then the accountability, right? I mean, we all know that what is the impact of that? We're not afraid of making, showing the numbers of how many people we serve. And
you'll get it. Yeah. You'll get an amen on that. Being on the board of a CDFI, I'm like smiling. I can't stop smiling with what you're saying, Janie, because these are the challenges of actually getting money to the places where either the underbanked or unbanked are, and being able to actually target that, especially if from a state, local, federal government cannot get it targeted, because that's what's going to actually boost these neighborhoods and the economies surrounding them.
So this is terrific dialogue. I want to spend our last time that we have working through some of the questions from the panelists, and or excuse me, not from the panelists, from the audience, posing to the panelists. And I think what we'll try to do here, if it works, is have just one of you answer, whoever makes most sense, the questions, so we can try to get through a couple of these. But if you have something else to add, by all means, a second person could come in. First, for Janie, average percentage subsidy needed to maintain, this is from Kevin Peterson, a healthy microloan program to make borrowers successful. How much subsidy do you need to maintain the program?
Oh, goodness. Well, it just depends on your pricing as well, right? But if you can raise between 30 to 40%, I mean, that's a good number. So in terms of subsidy, I mean, we're striving one day to be at 80%, something that we would only need 20% subsidy. We're not there yet. So it's just, it's a lot of hard, that's why the banks don't want to do this work, because they don't make money. We don't make money off these portfolios. So so subsidy is, you know, between 25 to 35%.
Great. And this question from David Black. Hi, David. We've had businesses and business owners that have blemishes on their credit now, in large part not due to their own fault. Can anything be done to mitigate that, whether through the credit bureaus or through different underwriting processes?
Well, I'll take that one as well, Brett, because that's why some CDFIs exist, is because the regulatory environment with banks, you know, it's hard to change that. But being non-regulated CDFIs, we can, you know, it's ironic, but it's by borrowing money, paying it back on time, raises your credit score. So that's what we're doing, is we're getting people to level that financial playing field by saying to them, it's important that you not only take out our loan and pay it back, but also when you have a lease on your apartment, don't break it. We teach all of these things. When you have a lease on your you know, cell phone or whatever it may be, don't break it. It's little things like that that you and I probably take for granted, but in our communities that we serve, that is not taught. And so we've got to educate folks on how to protect their credit scores.
Great.
The only thing I'll add is that we are taking a page from the CDFI playbook and attempting to do that through our branch network, because we recognize that financial fluency is extraordinarily important. It was always important, but especially now, helping people with even small strategies that can significantly help them thinking about what's going to happen for their business 3, 6, 12 months from now is part of why we are, you know, kind of getting our hands further in the dirt, whether it makes money for us or not, because if you're not helping the overall economy, none of us actually benefit. So, you know, it's incumbent upon us supporting CDFIs like Liftfund and others with that same type of thought process to help these small businesses and business owners.
Great.
Fred, I would just add to that. I think this environment has changed the applicability of credit scores in a number of situations. If you have a mandatory forbearance or modification, that may not show on a credit score. You know, likewise, you know, credit scores often don't have the most up-to-date information about a business. So particularly on the business side, I think this has motivated a transition, you know, to maybe using credit scores as one component, but also focusing on cash flows and the live fundamentals of a business, and not just not just the number that's provided by a credit bureau, because the reality is that the environment we've got is so much more dynamic than what a lot of the credit scores would suggest.
Absolutely agree, Jason. And we won't be able to lend responsibly in 2021 without that level of modification for looking at what's happening real time.
So comment from Eric Weaver I wanted to bring in, which was that PPP fees that lenders earned were not adequately scaled to the amount of the loan. And that is one of the reasons why we didn't see as much lending to small businesses, and that it takes money to, you know, make loans happen. And so some sort of minimum or scaled fees structure or types of return, Eric's point. In terms of trade-offs for policy dollars, Raymond Grave asks if you'd like to see more money put towards PPP or something that's more like SBA, CARES Act 1112, microloan. You know, where do you want to see your dollars go if we've got scarce federal resources? How do you want to see them applied?
I'd like to see them applied closer to the ground, smaller businesses under 50 employees at the very start. I think that you have to have a coordinated program that allows, whether it's PPP or called something else, that allows for digital access to applications, that allows for CDFIs to be a part of that same mix, so that when we're out basically canvassing small businesses and business owners, they have options to leverage the relationship that they have best in order to get themselves into the process. Because I think that the way that we had segmented it this first time has a lot of room for improvement. And if you want to make a scalable difference in the economy, it's got to be thought about in what channels are you going to go out and try and get applicants to apply. And that needs to happen all at the same time, not in this stage tiered approach.
Yeah, I would agree with that. I think that two elements to consider. One is on the PPP side, because it was not a particularly selective program, you ended up with some really egregious situations where, multinational corporations were able to structure their application in a way with multiple subsidiaries and could collect, $70 million, $80 million, $100 million from the government just by submitting a 3-page application and checking a box. And some of these results seem a little disproportionate to, or more than a little disproportionate to what the program's intention was. I think for a program, if you're focused close to the ground, as Chris says, businesses under 50 employees, loans under $1 million, I think you'll have a much greater, you might have a slightly smaller program, but you'll have a much more impactful program. The other thing to consider is ultimately the scale of these programs is in part the design of the government, but also the demand from the private sector. So PPP is a very expensive program for the government. It costs about $1 for each dollar that's put out. Whereas the SBA microloans and other programs, because they require repayment, are much more affordable and much more sustainable, and could provide more businesses with more runway, particularly at the smaller level, for each dollar that's allocated. And as it looks in the present environment, like the size of the next stimulus package will be a significant political question. The affordability of these programs and the way they're targeted should be an important consideration.
I think we have to learn from our lessons from these programs that we just administered in the last few months. If you think about the PPP program, it was difficult. And the demand, at the end of the day, there was more money than demand. Think about that, right? On the opposite end, the CARES money that was put out and the way we were able to administer it is much more simplified and relevant to those small businesses that we want to reach. As I stated earlier, their criteria was 1 million. In some cities, it was 1 million, some cities 2 million, but still 2 million is still very small. And this is revenue. It's not, it's not net, right? I mean, it's total, just revenue. So, so that's important for in terms of lessons learned. What do you want more money in? Well, you want the more money into the ones that were used. I also stated the demand in those grant programs was was higher than the actual dollars in place. So we could have taken, I wish we could have taken that PPP funds that were left over and put them into the CARES and then, put those monies out, because we see them on the streets right now. People are alive, thank goodness, because they were able to receive these grants, and the grants ranged from 25,000 up to 75,000. It wasn't like huge amounts of money, but they know how to work every single penny and able to use those dollars and leverage those dollars.
Great. Comment from, or question from Brenna McCallick asking about greater data collection and transparency. And I guess rather than going around on this, I'll just say that there was differential and less data captured under PPP than there is under conventional 7A and 504 products, and court cases filed. And so I would underscore the importance in adequately collecting and disseminating, releasing data so that we can speak to the important questions of who benefits how much, and who doesn't under these kinds of programs. So we're close to wrapping up, so I'll just give last word to each of you. If you could just take 60 seconds and describe, I mean, there's so much that goes into owning a business, the emotions, the work, the relations, the managerial stuff. You know, the loans are part of it. They're facilitative. But if you can, step back in terms of your biggest single takeaway, what we need to do as a nation to support our business owners, what's your biggest thing that you want to leave the audience with? Any order, 60 seconds, then we're going to wrap.
I'll try and go. A couple of words that came immediately to mind, Brett, were grace and resiliency. Grace from the population at large, recognizing that the smallest of small businesses are what are actually driving the economy, and that people should feel very, not necessarily upset, but they should be disappointed that we in this first round through the pandemic did not get money to those smaller businesses. We have an opportunity to fix that going into the foreseeable months. That has to be done, because you cannot allow for the creativity and resiliency of the business owner to be lost based on our inability as a collective to support them in something that they don't control, which is the pandemic.
And I'll add gratitude. When you hear a customer call you and say thank you, and send you cookies, baked cookies and so on, they are just grateful because people just didn't know what to do. And for Liftfund, we all of a sudden became on people's spotlights. They didn't know we existed, and now they're coming to us to see how else could we help. So we just have to be grateful for where we are right now, so we can continue to do more of what we're doing, and keep these businesses alive. So let's have another session like this in December of 21, and let's talk about success.
And I guess to grace and gratitude, I would add grit. Watching businesses through this period and how they've changed, how they've adapted, how they've managed has been a really remarkable sight in the face of adversity. And I think that small businesses are a phenomenon, and their impact on our economy is unique to America. It's something you don't see in most other nations where there's more concentration. And it's an incredible asset that we have. At the same time, it also, it's a difficult asset to build. It was only in 2017, 2018 that we had recovered to have the same number of small businesses in this country that we had before the 2008 financial crisis. And I think one of the core challenges we should take on as we think about coming out of this period is how can we re-accelerate the growth of these businesses and sort of restore the asset that we've got with entrepreneurship, with the employment base they provide, with the economic activity, and really the character that they add and uniqueness that they add to our economy.
Great. So grace, gratitude, grit, I hope also for generosity from the federal government to support the sector in efficient ways. Thank you so much, audience, for joining us. Thank you so much, panelists. This was a terrific dialogue. Hope you found it as engaging as I did and learned as much. Look forward to being in touch. Be well.
Thank you.
Thanks, Brett.